Today, we're going to talk about something that's hiding in plain sight on every single stock chart, something most people ignore, but it's probably the most powerful piece of information you can get. I'm talking about volume. It's the secret to figuring out what's really going on behind those price wheels. We've all been there, right? You see a stock price shoot up, or maybe it starts to fall. That's the headline. But price can lie to you. It tells you what happened, sure, but it doesn't tell you the real story behind it. It doesn't tell you if that move is for real. So, how do we find out the truth? And that brings us right to our first big idea here. We've got to separate the headline from the actual evidence. Think about it like this: price is just the advertisement, but volume? Oh, volume is the proof. Okay, so check out this analogy. I love this one. Imagine a restaurant. The price chart, that's the flashy neon sign out front. It looks amazing. It's advertising the best burger in town. But the volume, that tells you how many people are actually inside, eating. If the place is packed, the food's probably legit, right? Well, a big price move on high volume is exactly the same thing. It means there's real participation, real belief in that move. That's why you always hear traders say volume equals validity. So, how do we actually read that conviction? It's simple, really. There's one core concept you absolutely have to get, and it's called effort versus result. Just think of it like this: the effort is the volume, all the energy being poured into the market. And the result, that's the price move itself, how far the market actually got. It's kind of like pushing a car up a hill. Let's break down the three big ways this can play out. All right, first scenario, the healthy move. This is exactly what you want to see. You slam on the gas pedal, that's your high volume, and the car just flies up the hill. That's a big, strong price move. See? The effort perfectly matches the result. It tells you there's real strength, real excitement behind this. The trend is legit, it's valid, and it's probably going to keep going. Okay, but now, what if you floor it? I mean, massive volume, and the car just inches forward? That's a huge red flag. On a chart, this looks like a tiny little price candle sitting on top of a gigantic volume bar. This is something called absorption, and what it means is that buyers are pushing with all their might, but they're hitting an invisible wall. Some big seller is just quietly soaking up every single buy order. So you got to remember this. When you see massive effort for a tiny result, some major player is standing in the way of that trend. And then there's the third scenario. The price is just kind of drifting higher, but look at the volume. It's super low. Now, this doesn't mean the buyers are incredibly strong, not at all. It just means the sellers have gone home. They're just not there. There's no resistance. The price can float up easily because nobody's trying to stop it. This is a move born out of apathy, not strength. And recognizing that is, well, it's just as crucial. So, you see where this is going? This is how we start to peek behind the curtain and see what the biggest players are up to. The whole effort versus result idea, it's basically a roadmap for following the footprints of what people call smart money. And why should you care? Well, get this. Institutional funds control something like 80% of the entire stock market. Think about that. When they want to buy or sell, they have to move a massive amount of shares. You just can't hide that kind of activity. And where does the evidence show up? You guessed it, as giant spikes in volume. So when we track volume, what we're really doing is tracking the smart money. This all leads to two classic patterns you've got to learn to spot. First up is stopping volume. Picture this: the market is in a free fall. Everyone's panicking, selling everything. Then, out of nowhere, bam, a huge volume spike hits, and the price just stops dead in its tracks. That's the smart money stepping in, scooping up all those shares from the panic sellers. Now, on the flip side, you've got a buying climax. The price is going to the moon, the news is euphoric, and you see the biggest volume bar you've seen in months. It looks like incredible strength, right? But nope, it's often the smart money using all that public excitement to unload their shares right at the top. Okay, hang on. Before we go any further, we have to talk about something. We need to clear up the single biggest and probably most expensive mistake that almost everyone makes when they first start looking at volume. And it's all about the color of those bars. So when they ask you a question, just think about it for a second. When you see a big, fat, green volume bar in your chart, does that mean the buyers were in control, that they won that round? The answer, and this might blow your mind, is a simple, flat out no. It's a total myth. Here's the real deal. For every single transaction, there has to be a buyer and a seller, right? One for one. Volume just counts the total number of shares that changed hands. The color? It just copies the color of the price candle for that same period. If the price closed higher, the bar's green. If it closed lower, it's red. That's it. So from this moment on, I want you to completely ignore the color. The real story, the only story, is in the height of the bar. And once you start focusing only on the height of those bars, you unlock one of volume's greatest superpowers: its ability to act like an early warning system, a signal that a trend is getting tired and might be about to die. This phenomenon is called volume divergence. Now, in a healthy, strong trend, when the price hits a new high, you'd expect the volume to be high too, maybe even higher. It shows more and more people are jumping on board. But what happens when the price keeps inching up to new highs, but the volume is actually getting lower with each new peak? That's the divergence. Think of it like a rocket running out of fuel. It's still climbing, but its engines are sputtering. That is a classic sign that the trend is exhausted. It's losing momentum, and a reversal could be right around the corner. All right, I know we've covered a ton of ground here. So let's pull it all together. Now let's create a simple checklist that you can use on any chart, starting right now, to turn all this theory into a real practical tool. So before you ever think about making a move, just quickly run through these 5 steps. First, compare the current volume to the recent average. Is it unusual? Is it super high or super low? Second, does the effort match the result? Is that big volume bar producing a big price move or a tiny one? 3. Where is this happening? Pay extra attention to those volume spikes when they're near key support or resistance levels. 4. Check for divergence. Is the price going one way while volume is going the other? And finally, number 5, and this one is maybe the most important: wait for confirmation. Be patient. Let the next price candle prove your analysis right before you jump in. Look, if you remember just one thing from all of this, let it be this: price can lie, it can be manipulated, it can be pushed around, it can tell you a story that just isn't real. But volume reveals the truth. It shows you the conviction. It shows you exactly where the real money and the real commitment are. It is, without a doubt, the market's truth serum. So the next time you pull up a chart, I want you to do something different. Don't just stare at the price. Look down. Look at the volume bars underneath. Ask them, hey, what's really going on here? Because I promise you, once you learn to speak its language, your charts are going to start telling you a much deeper and way more honest